Hi guys, welcome to Money Control. This is Markets Weekly and I am Karunya Rao. And today we have Mr. Manish Sontalia joining us from Motilal Oswal Asset Management Company. Mr. Sontalia, great to have you on board with us. It's a very important
Thanks
week
for
as
having me.
well. Just a few days to go for the budget. Just help us understand what, according to you, is going on right now because we're still seeing a lot of turbulence, a lot of caution, especially the last couple of days.
No, I think, ever since the Fed has said that interest rates in the US can go beyond 5%, there's again a reset of
Hmm.
valuations that are happening. So, prior to that, basically it was all getting factored in as far as global equities were concerned. And even in India, that interest rates closer to 5% has all got priced in. But now, after that statement has been made by the Fed, it is all open in the air. And within emerging markets, India is one of the most expensive markets, and so uh, we are again seeing a bout of reset of valuation, and that's leading to some sort of selling again.
Okay, all right. Since you said we're one of the most expensive markets within, the emerging markets basket, um, do you see some more scope of a correction from here on? Are you saying the levels we're at right now are also a tad bit high?
No, see, what I'm saying is Indian markets are not going anywhere in the immediate short term.
Hmm.
And I think it's going to be a broadly sideways market. It's not going to go up significantly. It's not going to go down significantly. A lot of flows are moving to China, and in China, valuations are actually half of what India valuations are, and so they are more attractive. And that is also the case with respect to many other emerging markets. So yes, within India, I think the most vulnerable sections of the markets where the P multiples are or the valuations are relatively quite high
Hmm.
with respect to what the market valuations are, they can see a lot of selling. In fact, my only apprehension is that for the whole of last decade, ever since 2007-8, when interest
Hmm.
rates were actually moving down to zero, you know, uh, the consumer stocks, so to speak, when we call them growth stocks, uh, went up with or without the profit growth numbers. So if it was profit growth, the stocks would grow up and go up, and if not, the valuations would get reset on a higher. I think all of that is broadly over. With now the Fed funds rate at 5%, which is a very high number, and there's no certainty as to when ultimately the rates are going to come down. It's going to be flat for a while, and then maybe start to go up again. So, all in all, I think within the consumer space, that's the most vulnerable section of the market. Can see some correction.
Okay. But if we look at the bright side, are there any pockets that you think are attractive or have more promise at these levels as well? I'm sure there are certain, uh, you know, um, pockets or baskets right now which still are at comfortable, in a comfortable position valuation wise.
Yeah, so wherever there's profit growth, and broadly, markets are going to see something like 15% sort of an earnings growth in FY24 over FY23.
Hmm.
And this I'm talking about the Nifty. Broadly, the earnings growth is going to be led by your banks, although not as high a growth as we have seen in FY23, but still a very decent 15 to 20% sort of an earnings growth. That is one space which looks very interesting, and there is deep value in that space. Sorry, within the banks, there is ample value, and even within the four or five large private sector banks, and including even State Bank of India, I don't think valuations are prohibitively very high. And broadly, the earnings growth sort of a return multiples would broadly come about. Then we have the IT space, which has been hammered because of the ongoing talk about recession in the US. Again, I think too much has got built in and overpriced on the negative side. Again, this is one
Hmm.
space which is representing value. And the third space is broadly your pharmaceuticals. Again, I think the worst is broadly over. You may not see too much of a downside out this side because it was very high base of fiscal 21 and 22, which is getting reset in 23. And again, 24 is going to be a growth year, is likely to be a growth year when we will compare it to FY23. So these are the three broad spaces which I think should be outperforming in
Hmm.
fiscal 24 if we compare it to fiscal 23.
But don't you think sectors like IT could get further hammered if there are, in fact, more concerns or persistent concerns about recession, especially in bigger markets like US and the UK?
So the talk and commentary about recession getting priced in US IT
Hmm.
stocks, has been continuing for the last 12 months.
Yeah.
In that backdrop, you look at the quarterly numbers that come out of the Indian IT companies, all numbers have broadly been maintained. Even for this quarter, revenue numbers were broadly there. Margins were better than estimated. And I think it's a no-brainer and it's got fully priced in that by the middle of this calendar year, US will go into a recession. But if you look at the stock prices of the big tech out there, many of the
Hmm.
big tech companies are almost up 50% from their lows. So,
Yeah.
it does seem that most of the negatives about FY24 already priced in. Now it's the time to look beyond it and focus on FY25. FY25, you're building in zero movement in rates on the higher side or even some sort of a cut. And obviously, with this sector, I think should be leading the total Nifty earnings growth, which means many of the names in the IT space should be growing at more than 15% when we
Yeah.
compare
Yeah.
the Nifty earnings growth of 15%. So that is why it's relatively going to be an outperformer. I think most of the negatives regarding the recession, as far
Hmm.
as things are visible and available, are there already in the price, and even valuations have corrected. You could argue that valuations are not there still if you compare it to 5-year mean. But in the last 5 years, a lot has changed for the IT space. Dividend
Yeah.
payout ratios have gone to 100%. Digital transformation is still an ongoing secular process. And if we are talking about artificial intelligence, electrification of vehicles, all of these innovation technologies having taken a pause due to recessionary conditions, a lot of spending on these things will again come back. So I think the
Hmm.
journey is far from over for the IT companies, and I think there is deep value, or there's at least some decent value in the IT space.
Okay. Okay, great. When you say IT, are you hinting at large cap IT services companies, or are you talking about consumer tech, which also have been hammered down quite a bit? Then, of course, there are the mid and small cap IT players as well in the market. So, which bracket are you most, optimistic about?
So I think there's greater stability in times of recession in large
Hmm.
established IT companies. Like, so if you want to delve down a bit deeper, then you should be sticking with largest mid cap IT companies.
Okay.
During recessionary conditions, it's basically the small cap IT names which are likely to be hammered the most. And particularly in small cap IT names, you are concentrated in a particular geography or concentrated in a particular vertical that
Hmm.
enhances the risk. So large IT names or largest mid cap names. When I talk about largest mid cap names, you could talk about market cap of 30,000 crores and beyond. These will
Okay.
tend to do much better than the small cap names, I would believe. When it comes to consumer tech, again, we are talking about specific names out here, and obviously, one of the most known consumer tech
Hmm.
names today, according to me, in deep value zone. I'm
Hmm.
not buying this stock at three-digit numbers or twice at what the market price was when the IPO came, but I'm buying it at a fraction of the listing price. And according to me, with very decent cash in their books, and if you have a 3-year horizon, there's value on the table in this thing. So I would be a buyer in this thing.
Okay. You started the conversation by talking about how you feel about banking stocks. So let's talk about that because there are quite a few banks in your portfolio. But if we look at the recent performance, of course, following the run up in banking stocks, almost all banks underperformed Nifty after the announcement of their Q3 numbers. Now, going forward, several experts and analysts see company specific headwinds which could perhaps cap the upside. Do you agree that in the near to medium term, perhaps there could be some more? volatility or some kind of correction in select banks?
Look, obviously on a very high base of 2023 fiscal, earnings
Hmm.
growth is going to moderate for all banks, primarily because the NIMs have seen the maximum expansion in FY23, and interest rates will be reset on the upside, particularly when it comes to repricing deposits. And also the fact that loan to deposit ratio or CDR ratio, credit to deposit ratio, is running at all time highs, beyond 90%. And LCR, is also likely to follow. So these are maxed out ratios, So you would have to actually up your deposit rates. That will get reset, and NIMs probably have maxed out or will get maxed out in the next quarter. So you have seen peakish NIMs for most of the established banks. Your credit growth is not going to be as high as 15% for the system. It's likely to be around 12%. And, your valuations have nothing left to be there on the upside. So what is happening
Hmm.
today is that 20% sort of a growth for large established banks, whether the valuations are today palatable. I would believe that in the second half of this fiscal, it would start to become very palatable, because beyond the fourth quarter of this year, which is the current quarter of this fiscal, you'll start to price in FY25. And once you get into FY25, there is ample upside when it comes to all the banks. So maybe a bit more correction on these banks, but banking is likely to deliver positive returns if you are to take 2 years point of view.
Okay, all right. I was going through a report, an interview that you had given to Moneycontrol about a month back, early December, to be precise, and you were fairly optimistic about foreign institutional investors also coming back to the market in a big way, 2023 especially. What are the triggers there that you think will or could potentially attract FIIs to India vis-a-vis other EMs?
See, when all of the negatives get priced in, that's the time to basically, turn the obvious. So obviously today, on a relative basis, you are seeing, China getting the maximum flows, and overall emerging markets will get their flows. Now within that, it's going to be China, it's going to be India on relative valuation basis, plus bolstered by earnings growth. So today, going into the next year, I think the first 2 quarters are going to be slightly headwinded, and the next 2 quarters are going to be tailwinded. So everybody follows earnings growth. So the FI is also going to follow earnings growth. What I believed when I made that comment about positive FI flows previously was that they have been selling very big in the whole of fiscal 22 and 23. And obviously, when rates were predicated to be around peaking around 5% or somewhere like 4.5% in the US, I believe that most of the negatives were there in price as far as India was concerned. And plus, the earnings
Yeah.
growth trajectory also looked like that it would be 20% for FY24 as opposed to 15% currently, because inflation has
Hmm.
really reared its ugly head big time. And your China-Taiwan issues, also their geopolitical tensions have not yet eased. So all these concerns were there. But again, broadly, I would believe that once China goes up slightly more than what it has already, it's again going to, be a case of pick and choose within the overall allocation to the emerging markets. And India is likely to get their share, but it would be more back-ended for fiscal 24 rather than front-end.
Okay. Talking about the state of the economy, clearly the budget is going to be the big event to watch next week. So the street will also be very closely keeping their eyes on that. When it comes to budget 2023, from a market standpoint, what do you think could be the focus this time around, sector-wise or even reforms-wise?
I think, see, we are entering into an election year, right? And this is
Mm,
going to be the last year before the elections when the budget is presented. After that, it's going to be a vote of account, and the new government is going to
yeah.
present the next budget. So, obviously, a lot of money is likely to get placed in the hands of the consumer, so that there is a feel good factor. But it's going to be a tough war. It's a tightrope because your FRBM targets have to be reset now that we are out of the pandemic. So obviously, 6.4% fiscal deficit number is going to come down to 6.2 for fiscal 23. But for fiscal 24, anything more than 5.8 is not going to be looked at in good light. So 5.8% does not leave too much of room for expenditure increase. So now, given the slowdown, etc., revenue collections, particularly on the taxation side, should be built in at 5.5 to 6% sort of a growth. Expenditure should be more allocated to capital expenditure rather than your subsidies. Of course, this year overspending has happened in fertilizer, food subsidy. So I think broadly three things to watch out for. One is the fiscal glide path. Second is your disinvestment numbers are failing miserably. And if you got to
Hmm.
augment your revenue for fiscal 24, you must focus on non-tax revenues, how that is going to be met. Of course, even in fiscal 23 budget, 65,000 crores, hardly 31,000 crores has got disinvested for this year. So that is again one number where one will watch out for. Incentivization for PLI, capital expenditure on defense, railways, and other areas, roads. These are the things. So overall allocation to capital expenditure is broadly estimated to see an increase, which will please the markets. And some balancing between rural consumption because you are entering into an election year. These would be the key monitorables. Plus, if you get an inclusion, doing something when it comes to inclusion of government bonds in overseas index, JP Morgan index, that could be the real kicker when it comes to flows into India. You could easily get 25, $30 billion worth of. I would watch out for these things. Other than that, it would be just, you know, some bit here and there.
Okay, all right. And of course, the Fed meeting also, the outcome of that, again, Fed first. So important day from a global and a domestic standpoint. But if we look at the forecast for 2023, I remember that a few months back, I think July, August, you had said that we could see 15,000 on the Nifty again. But, you know,
No, I
right
said
now, if we,
15,000 won't be seen. 15,000
okay.
on the Nifty will never be seen, not be
Yeah, you
seen.
won't be seen. I'm sorry. So you were saying that 15,000 is not something that we will see anytime again on the Nifty 50. And right now, when we are, hovering in that range for many weeks or months, in fact, for now, for 2023, what is the big level to watch out for? Do you think we can hit 20K anytime this year, anytime soon, than later this year or the end of this year?
So, 15,000 is not to be seen in a long time. Let's put it
Hmm.
that way. I don't think we are in a bear market rally. That time, when I had made that comment, it was falling like nine pins. Indian
Yeah,
markets were falling like
yeah.
nine pins. But even then, what I had alluded to was that it's not a bear market rally when the markets had gone up. It's basically your bull market. India is in a bull market. It's deep corrections that you see, and that's how it is. Even now, I am saying that India is a growth market. It's one of the bright spots in the global context. It's India's golden decade. You're likely to see 20,000 on Nifty this year only, fiscal 24. But as opposed to previously estimated that it would be seeing that in the first half of this fiscal year, fiscal 24, is likely to be seen in the second half of this fiscal year. But
Hmm.
broadly, I believe that 20,000 on the Nifty will be seen this fiscal only.
Okay, that's very heartening to know. Um, I want to understand whether you also foresee the broader markets participating in that up move because they have still been quite slow and sluggish.
No, I would believe this time around the movement is going to come from the large caps. You
Okay.
have seen some very decent run, and thanks to retail HNI flows, thanks to very easy monetary regime that we have been seeing over the last 2, 3 years, all of those things are changing at the margin. Cost of capital is going up, liquidity is falling, and then the ease of availability of money, capital is here to stay for some time. So in that backdrop, best of the returns are largely going to come from large caps. Mid caps and small caps should trail large cap returns. If not on earnings growth, then surely on valuations because their valuations are now at par with large caps or even in some pockets premium to large caps, which is not warranted
Hmm.
Mid cap and small cap generally trade at a discount of 25 to 40% to large caps, and that should have some mean reversion when it comes to valuation reset for the mid and the small cap space.
Before we let you go, I also want to understand what has been your biggest investment mantra that has helped you ride the tide for all these years? Because 2022, of course, was something that was largely unprecedented. Many retail investors saw something like that, a volatility to that extent, macros sort of, spiraling out of control in several markets, several developed markets. So, with so much happening, what has been your biggest learning from 2022 and a mantra that has been evergreen for you and it's almost always worked for you?
One is don't bet against India because obviously we understand only India. So don't bet against
Hmm.
India. That has worked because India is a growth market and it's here to stay for many years to come. And the second is don't try to become rich too quickly. Once you try to do
Hmm.
that, you're taking all sorts of risk. Disciplined way of investing, and you will have many times your capital as your ultimate capital when it comes to your financial goals. So investments in a disciplined way. Don't try to take too much of risk. Uh, Bet on structural themes in India's context and buy on growth because in India only growth works. Don't bet against India. These are the mantras which I have followed and have broadly
Hmm.
worked, this far.
All right, great to know that. And thank you so much for sharing your knowledge and insights with us and our viewers. Thank you so much, Mrs. Santalia, for joining us once again on Money
Thank you.
Control.
Thank you.
With that, it's a wrap on Markets Weekly. Thank you for tuning in.